Hey everybody, welcome to the morning market briefing. It's Wednesday, January 25th, 2023. Hope you're doing well out there. We do have quite a bit to get to in the form of earnings here momentarily, but we're going to open up with a little bit of a thought exercise as inspired by a blog post shared by Tim Rose, the guy we referenced from the Wall Street Journal, who seems to really have pulse quite conveniently as to what is going on with the Fed. But opening up with kind of this question, what if inflation comes down significantly faster than what the Fed expects? Where could that put us? Ben, Tom, there was an interesting article about this, kind of got us thinking a little bit. Where would the Fed go, and why do you think Tim Rose is bringing this up?
What's really interesting here is that John Roberts, not that John Roberts, another John Roberts, who is a former Fed economist, he actually uses Fed models to predict where rates would be, where unemployment would be, and where the treasury markets would be. And it's really interesting because he talks about the baseline of where the Fed is right now and when they expect to start cutting rates. Again, we mentioned it on the macro, but the Fed does expect to cut interest rates by 100 basis points in 2024. But if inflation falls faster, his moderate policy response, John Roberts' moderate policy response, and he says this is not his base case, but if inflation falls faster, he says that they would cut rates by 250 basis points this year, by the middle of the year, and potentially 400 basis points if they really wanted to get a little bit more aggressive. So there are obviously big time consequences of this if this would happen. Again, this is a exercise that he's doing, but I'm curious, Tom, what your thoughts are as to the validity of it, whether you would expect the results, but probably more importantly, would the Fed actually do this?
I think that if everything played out that way, they probably would. And I think that's what the market is anticipating now, sort of on a smaller scale, right? Because the market is showing cuts for this year, but not 200 basis points. I think where it gets fouled up is I worry that wage inflation is still an issue and the jobs market is still very strong. And I think that's what's going to really prop up inflation, say between 4.5% and 2%. I feel like that's where we're really going to stall out. And the reason for that is we have yet to see the jobs market really get hurt. I mean, we've seen Google and Microsoft and all these big mega cap companies start to lay off people, but they probably overhired to begin with.
Yeah.
And I don't know that that is true for every company. If anything, a lot of companies laid people off during the pandemic, didn't hire them back necessarily, and they're trying to get leaner, cleaner, and they're not in that cycle where the tech world was hiring aggressively during the pandemic, offering people all kinds of unbelievable packages and work at home deals. And now they're like, oh, well, turns out the reality of the pandemic is not a reality in 2023, and they're laying people off.
Harvard is a company that we were actually looking at yesterday and continue to look at. They've laid off 20% of their employees, and they're actually doing more sales.
Yeah, and that's the thing is I think a lot of companies got leaner. And so I don't know that that's going to be a reality. That being said, if they do cut 200 basis points, that would put us in what I would really call more of a normalized yield curve. Because what's considered a normal yield curve, the 2-10 spread is somewhere between 1.5% and 2%. So right now we're inverted, right? The 2-year Treasury is somewhere around, I don't know, 4.25, and the 10-year Treasury is at a 3.45 roughly. So we're inverted. But what would happen if they cut 200 basis points is likely you would end up with a 2-year Treasury somewhere in the 1.5 range, and the 10-year Treasury somewhere in the 3.25 range, which is a normal yield curve. And that would be a normal place to be in terms of the structure of the yield curve, which would be ideal, right? The idea would be they get to a point, inflation comes down, they hit a soft landing, they cut rates, and now we have a yield curve that is normalized, which we have not really seen in that capacity for, now 15 years, since 2008, and we haven't seen that. And that would be an ideal scenario. The question is it a reality? I think it is, but I don't think necessarily it's in 2023. I think it might be closer to 2024, if not 2025, before we get a normalized yield curve.
So then the follow-up question is, because this is what I see from bears all the time, the Fed cuts rates, and then there's a recession. We saw that in 2019. We saw that in 2007. I think we saw that in 2000 as well. But at least in the last two times, Fed cuts rates, and then about a year later, boom, there's a recession, potentially pretty big one.
Correct. And then also, if they cut rates, I mean, on the flip side, there's a possibility if they cut rates too early, inflation comes back, right? And then we get in this hike cut cycle, which is more like the 70s, and then we're in more of a stagflation situation. So it remains to be seen, I think. And I went down to Georgia Tech last night and spoke to their fixed income committee, and they were asking questions about what I thought was going to happen. I think that the base case is this is going to take a lot longer than people think. I think the way it should go is the Fed should raise rates and then hold. If they can hold successfully and not cut, I think that's the best case scenario.
Yeah, the longer they can do that, the better.
Because then naturally you're going to have either the long end come up, or there's going to be a situation where we see a leveling off of the yield curve where it's not so pronounced on the front end. But I just don't see a need for them to cut. I feel like it just doesn't make sense at this point, because inflation is still, historically speaking, very high. And until we get to a number closer to 3, I just don't think that they're going to do it. I don't think they should, because I think you're going in two ways. One is we're headed into a recession because they cut rates just like 2019, just like 07, or we're headed into a 1970s where inflation starts to fluctuate, and they're just trying to chase it all over the place. I think the best place is just to keep it high. If inflation continues to come down, stay where they are. If it starts to rear back up, they hike again. Just kind of be more agile rather than being like, we're definitely going to hike and then we're going to cut. Like, that doesn't make any sense. It doesn't, I just don't know that seems like it's going to cause more problems than not.
2 questions. Should we be focused more on the month over month or year over year data? Number 1. And then number 2 is, if inflation does continue to come down and we follow this path, what's the investment? How does that, what's the play, especially in fixed income?
I think the month over month is probably the most important, because that's really showing what the next 12 months is going to be. But we need more data, right? 3 or 4 where we're starting to really average into something like 3%. Like last month was awesome, but
it's just a month.
It's just 1 month. Yeah. 1 month, you're like, oh man, we made 1% on Microsoft yesterday. That means we're gonna make 365% this year, So over the course of 6 months, you might start to settle in and say, hey, we might make 10% on Microsoft this year on an annualized basis. So I think that's what we need to look at. If this plays out, I think the place to be is in that medium term, because you're going to get so much push up on 3 to 5 year bonds if they cut rates, because not only are you getting them very cheap because we're inverted, those are where the highest yields are, but also they start to cut rates. You still got time before those bonds roll off. So they're going to appreciate in value, but also you're locked in for a long period of time.
Because if you have 6 months,
yeah,
it's great while it lasts. But
yeah, if you have 6 month bonds and pay you 5%, that's awesome. But in 6 months, if rates go from 4 to 2, you can't reinvest and get the same. And so, that theory of the curve, I think, is best for this. For right now, I think it's just, if you can get 5% on 6 months, you take it, but you look for opportunities as well where you can lock in on longer rates. But if we're continuing to be in the hike cycle, I still think there's time to buy those bonds. And I think sometime over the next 6 months, we start to pivot away from really short-term bonds to some of that intermediate 3 to 5 year stuff. And then if they do cut rates, then you go long, I think.
And I think there's an application here for those out there listening. The market, and I would say maybe even more so than the market, but even just financial media and the headlines, when they don't like the wait and see game. They don't like to say, okay, the most important data is monthly data, but we need more than 1 or 2 or 3 months of this to really get a picture. So they like to make predictions. They like to make conjecture. And to be clear, that's not really what John Roberts is doing here. He's saying this is not my base case, but what if this is what it could potentially look like? I would not be surprised at all to see more talk about rate cuts coming up, whether it's on CNBC and the Wall Street Journal, Market Watch, wherever you get your financial news media. But I still think that's quite an outside probability in the short term, called the next 12 months. I also think agility is the key for the Fed. And I actually feel like we've gotten some degree of agility from them. We criticize the Fed a lot for slowness to act, and they kind of telegraph what their policies are going to be for these prolonged periods, and that's not always the most effective way to deal with an economy that's got a lot of moving pieces. I actually feel like the last couple meetings, they've been pretty agile. I think part of the media frustration and maybe the market participation frustration is they want to know what the next plan is. Hey, when inflation gets to X, what are you going to do? I actually feel like they're being relatively reactive in a good way. And that hasn't always been the case.
I kind of feel like we're almost moving into a period where it would be better if the Fed said less or anything at all.
Yeah.
It really started towards the end of Ben Bernanke's sort of tenure, where it was like, we're going to be exceptionally transparent about what we're doing. And Janet Yellen took that and took it to another degree, when we finally started to taper. And that's become sort of the cult of Fed following, is that, they're going to be way in advance what's going to happen, what we're trying to do all the time, talking in the media. But the problem with doing that is things change pretty quickly. I mean, things change very quickly from January of 2019 or January 2020 to March of 2020. And so when you're like, hey, 6 months from now, we're going to do X, and then you have a global pandemic, it totally changes everything. I think they really need to be more quiet about what they're doing, consider the data, and make the decision that needs to be made without regard for, hey, we said we were going to do this, because that's what's causing a lot of this volatility. Is like, they said they were going to hike 3 times, then they hiked 3 times in one shot, and then they did it repeatedly, even though they weren't sure if they were going to do it. And that causes all this volatility. People are like, what the hell is going on? They said they were going to do X, and now they're doing Y. Instead, just being like, we don't know what they're going to do, and then when they do it, the market reacts accordingly. I think that they've gotten this, like, we have to be so transparent, we have to tell everyone what we're doing. We're getting so much scrutiny from Elizabeth Warren and Donald Trump, and all these people are talking about what we do. In reality, they just need to be like, we're an independent body. We do what we do. We'll make a decision based on the data, and we'll tell you when we make it.
Yeah, I like that. Let's switch gears to earnings. Tom just said Microsoft was going to be up 365% this year. Ben, doesn't seem like that's going to happen. Down 3% on earnings. That was a joke, guys. He didn't say that. Well, he did, but
I did say it was.
But in jest, in jest. Big headline here really is on the Azure side.
Yeah, the PC growth is very bad. But everyone kind of knew that coming into it. Office 365 continues to remain strong. I think the ecosystem for Microsoft is very good. But Azure is their cloud business, and the billing's a little bit difficult if you're not in it, but essentially it's based on usage. So if you're using Azure and you're using a lot of that data versus optimizing your usage, you're going to be spending more money. And what a lot of companies have done over the past 6 months, really, and continue to do, is they're really optimizing that usage. They're saying, do you really need to use this? Do you really need to get those data logs every day or have a continuous feed? Or do you want to just access them once a week? Do you want to perform this analysis on an ongoing continual basis, or do you want to perform it once a week? So I think that's what we're seeing. I do think there's a seasonal element here that management didn't really talk about. I think they were pretty conservative on that. They said that the growth rate of Azure really fell off pretty significantly in the month of December, and that they're projecting that those declines to continue into the first calendar quarter, their third fiscal quarter in the March quarter. So I do think there's an element of conservatism. I would classify it a little bit more as de-risking their guidance versus outright caution. So it wasn't a kitchen sink, which is when companies say we're going to do terrible, and you lower the bar to the ground. But I do think they have, just tonally, I feel like they have good visibility over what they're going to be able to do in March. And I do think that they can beat those estimates. Having said that, you're still seeing the deceleration is probably not great. I could definitely make an argument that we're seeing the bottoming in growth for Azure and therefore for Microsoft. But with the macro uncertainty overlay, it's difficult to make that call right now. I think that with Microsoft, at its current valuation, I think that it makes sense to accumulate steadily but slowly over the period of the next 3 months.
Potential negative impact too for some of the other tech giants, whether it's Amazon, Google, Meta, if they're saying the same things thematically, just something to be cognizant of and be mindful of. Capital One Financial, seeing a lot of normalization across the board, but higher loan provisions created a bit of a headwind for them.
Yeah, but it was better than Discover. Discover was seeing major increases in charge-offs, and they were saying, look, we're seeing normalization if you look vintage to vintage, but our pay down rates on revolving credit are still elevated. You're basically seeing a normalization. And they said, none of this is really surprising to us. And we're ready for unemployment to go to 5%. Bear in mind, unemployment right now is 3.5%. So it's a relatively conservative outlook, both from Capital One and interestingly, they're using the same model as JP Morgan.
What are you seeing from Texas Instruments and ASML?
Yeah, so on the chip side, we're seeing declines, but there's a lot of confidence that we're kind of getting through it. The cancellation rates at Texas Instruments have appeared to slow. They didn't say that explicitly, but that was a big source of concern last quarter. It was less of a concern this quarter. Automotive's performing very well, and it looks like it's more of an inventory pull down than an end demand pull down. And ASML, which is the chip equipment provider, they're actually seeing sales up 25% this year. And the reason they're seeing that is because a lot of their customers, the chip manufacturers, are actually seeing growth in the second half of the year. And the market's always going to price out in front of that. And I'm surprised ASML is down this morning. I wouldn't be surprised to see a lot of chip companies actually catch a bid today or in the ensuing days as a result of this.
Also heard from, a slew of other companies. I don't know if there's any in particular you wanted to highlight, or
I would just call out a couple big ones that we've talked about in the past. First, Kimberly-Clark. It does seem like pricing it continued to accelerate from 9% to 10% on a quarter-over-quarter basis, but we're beginning to see a little bit of decline. Most of that was due to the professional division. They're really putting in big price increases there. But on the personal care side, you're actually seeing deceleration. And on the input cost side, you're also seeing deceleration. So I think inflation is coming down. The stock's actually getting hit pretty badly. So there's more going on there than I was able to capture. They only reported at 7:30. But and then on AT&T, it does seem like we're turning the corner a little bit on that company. You're getting better net subscriber additions. Cash flow is very good in my opinion, and earnings per share guidance was very good. It's definitely better than Verizon. I'd be curious to hear what Tom's thoughts are. The last one I would talk about would be General Dynamics. They provide the Abrams tanks and they're crushing it. They provide the tanks, they provide the submarines, and they provide Gulfstream, and on every business they're performing extremely well. So General Dynamics is definitely an interesting place to be, the most expensive place to be in defense, but definitely a lot on the hot button issues right now.
Yeah, given the year that the defense space has had, to be up 2% on earnings, you're crushing it.
Mm-hmm.
I feel like. Cool. Anything else? Any early feel on earnings season, Ben?
There's a lot of caution out there. There's a lot of caution with respect to the guidance. There's a lot of caution from analysts and investors alike. And you're definitely seeing a bit of an underperformance in terms of the earnings guide versus expectations. It could be a positive resetting of the bar. It could be a portent for bad things to come, a mild recession. People are basically guiding earnings. You saw it with Capital One. You saw it with JP Morgan. They're guiding earnings based on a recession, a mild recession. But that's the outlook with which people are providing guidance.
Yeah, and not necessarily shocking either. So.
Not shocking. And, it's one of those things where we get through this earnings season and potentially people could, and if we continue to get an improvement in the underlying data, slow down inflation, you say, well, this is about as bad as outlook as we're going to see for 2023. It can only get better from here.
Yeah. Yeah. And when you think of the valuation compression that we saw over the last year, we talked about in the macro, not necessarily caused the panic button.
Yeah. I mean, obviously, if the macro data slows, I think you just got to be, you're going to get whipsawed by a lot of these micro moves, but ultimately I think that it's going to be a macro market, and because a lot of these companies are guided based on what they perceive as a weaker macro market.
Cool. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day.